Welcome to this explainer. Today, we're doing something a little different. We're framing our analysis exactly like an executive-level investment briefing. We're looking at Tata Consultancy Services, or TCS, and diving deep into their highly anticipated Q1 FY27 results, covering the quarter ending June 2026. Look, if you're managing a portfolio or tracking equities in the IT services sector, this is the deep dive you absolutely need. We're going to strip away the noise and look strictly at what the data is telling us about their financial health, operational efficiency, and the real risks they're navigating right now.
Now, TCS is undeniably one of the absolute heavyweights in global IT services. But our core objective today is actually pretty simple. We need to separate their underlying operational performance from the exceptional legal noise that's been dominating the headlines lately. As you'll see from the data, just glancing at their net income this quarter doesn't tell you the whole story. We really need to dissect the actual engine running the business versus the one-off speed bumps they've hit along the way.
To do that, we're adopting a very strict, data-driven structure today, pretty typical of a hedge fund memo. First, an executive summary. Second, the revenue and margin trajectory. Third, we'll look at the demand pipeline. Fourth, we'll tackle the exceptional risk from the CSC lawsuit. And finally, we'll wrap up with a clear bull versus bear verdict. All right. Let's jump right into Section 1, the executive summary for Q1 FY27. This is our bottom line up front. Just look at the sheer scale of this revenue engine. The headline figure of 722.75 million rupees represents a massive 13.9% year-over-year growth. But the real question for analysts is, how does this actually stack up against street estimates from firms like Axis Securities and Antique Stockbroking? Do they beat, meet, or miss the consensus? Well, while top-line growth is great, efficiency is the other half of that equation. And here, TCS delivered a really robust 24% operating margin. Even with all the complexities in the global macro environment right now, holding a 24% operating margin shows exceptional cost discipline and pricing power. Their net margin sits at 19.2%, which, as we'll discuss in a minute, factors in some of those exceptional legal hits. And before we get lost in all the operational metrics, take a look at this 12 rupee interim dividend. With a record date of July 15th and payout on July 31st, this immediately signals management's confidence and their absolute commitment to capital returns. For investors, capital allocation discipline is a major pillar of the TCS investment thesis. Dropping an interim dividend of 12 rupees right out of the gate in Q1, that proves the cash generation machine is functioning exactly as intended.
Which brings us nicely to Section 2, the revenue and margin trajectory. Let's peel back the layers on that top-line growth. When you look at revenue growth year over year, it's basically a tale of three currencies. In Indian rupees, growth looks phenomenal, 13.9%. But when we strip out the noise of currency fluctuations and look at constant currency, well, the growth is a much more modest 3.2%. And in pure US dollar terms, it's just 2.7%. Plus, quarter-over-quarter USD revenue was actually completely flat. This perfectly highlights the tug-of-war happening right now between sequential margin compression from recent wage hikes and the offset they're getting from currency tailwinds. So the underlying volume and pricing growth is grinding forward, sure, but at a single-digit pace.
But here is where the company truly shines. Cash flow from operations stood at an incredible 93% of net profit. Why does this matter to us? Because in a high-interest rate, uncertain economic environment, cash is absolute king. A 93% conversion rate demonstrates remarkably high-quality earnings. It literally means the profits they're reporting on the income statement are actually hitting the bank account. They aren't tied up in uncollected receivables or masked by aggressive accounting. It showcases world-class working capital management.
Okay, moving to Section 3. Let's look at the forward-looking indicators, the demand pipeline, and verticals. Past performance is great, but portfolio managers want to know what's coming next.
That brings us to this monster figure, $9.5 billion in total order book TCV, or total contract value. And this isn't just volume, it's high-quality volume. This includes major wins like the reported $800 million SKF AI transformation deal, plus their expanding ServiceNow partnership. A booking number like this is the crucial fuel they need for future revenue realization. It gives us massive visibility into the coming quarters and proves that even with discretionary spending pressures in the broader market, TCS is still successfully closing these huge transformation deals.
Breaking down the quality of that TCV, we can see exactly where the demand is clustered. North America is still the absolute dominant pillar, contributing $4.7 billion to that total. From a vertical perspective, BFSI, banking, financial services, and insurance, is the heavyweight champion at $2.5 billion, followed by consumer business at $1.4 billion. What this tells us is that despite rumors of softness in the financial sector, major banking clients are still actively signing massive contracts with TCS.
Now, how are they managing those high-value relationships over time? Look at this retention and expansion data. At the very top tier, clients generating over $100 million, they had 66 in Q4, and they maintained exactly 66 in Q1, 0 leaks at the very top. Even more impressively, look at the $10 million plus tier. They successfully migrated smaller clients up the value chain, growing that bracket from 499 to 504 quarter over quarter. That kind of structural stickiness with mega clients is a massive defensive moat for them.
Let's talk about the cost side of those client deliverables. Headcount. Notice the structural trajectory here. Back in Q4 of FY25, they had nearly 608,000 employees. By Q4 of FY26, they had optimized that down to roughly 584,500. Now, in Q1 FY27, it's ticked back up slightly to 593,798. But the overarching trend from a year ago is a structural contraction in headcount, even as revenue grew almost 14% in INR terms. That signals a ruthless focus on margin protection and the internal leverage of AI. In fact, they've reported a $2.6 billion annualized AI revenue run rate, which is growing at 13.6% quarter over quarter. The big question now is whether this AI segment is a credible standalone growth vector that lets them do significantly more work with fewer net new hires.
All right, let's pivot to Section 4. No objective analysis is complete without addressing the elephant in the room. The primary bear case catalyst? The CSC lawsuit.
Let's walk through this prolonged timeline so we can contextualize the recent financial write-offs. This definitely didn't happen overnight. It started way back in April 2019 when Computer Sciences Corporation filed a claim over trade secrets. Fast forward to an advisory jury verdict in November 2023 and then a trial court judgment in June 2024 ordering substantial damages against TCS. But the latest and frankly most critical update for this quarter's earnings is that on June 15, 2026, the U.S. Supreme Court denied TCS's petition. The legal road for appeals essentially hit a massive dead end right there. So, what is the actual financial damage of that Supreme Court denial? It required TCS to record further exceptional items. They'd already provisioned $150 million in FY 2026, but in this specific Q1 quarter, they had to take an additional hit of $70 million for exemplary damages, plus another $7 million just in interest. As an analyst, it is absolutely vital to isolate these one-off hits from the core operational performance. Yes, it drags down the net margin, but it does not reflect a degradation in the day-to-day IT services business.
Which brings us to our final part, Section 5. Let's synthesize all of this data into a clear, actionable investment framework, the bull versus the bear verdict.
Let's hit the bull thesis first. If you are long on TCS, the data gives you plenty of ammunition. You're looking at an ironclad 24% operating margin in a really tough macro environment. You've got a massive $9.5 billion TCV pipeline locking in future revenue. You've got a business model converting 93% of its net profit into actual hard operating cash flow. You have an incredibly resilient defensive client roster where literally not a single $100 million client churned this quarter. And on top of all that, you're being rewarded with a strong 12 rupee interim dividend payout. Make no mistake, TCS remains a highly efficient cash-generating machine.
But the bear thesis is just as data-driven. The absolute most glaring red flag? 0% quarter-over-quarter USD revenue growth. The top-line momentum in hard currency has stalled out. Second, persistent legal provisions are continuously dragging down net income and headline EPS. Third, dropping headcount hints at broad-based volume pressures and maybe a lack of aggressive new demand. And finally, beyond their heavy reliance on North American BFSI, they are navigating intense global macroeconomic and geopolitical headwinds, including U.S.-Israel-Iran tensions, which heavily threaten discretionary spending. If a broader crisis hits, TCS's largest revenue pillar is directly in the crosshairs.
So, here is the ultimate strategic question facing portfolio managers for FY27. Can TCS translate that massive $9.5 billion pipeline into actual USD growth before their margin optimization levers hit a structural ceiling? Look, they've proven they can defend margins and generate cash brilliantly. But in a highly complex global market, just plain defense isn't enough to drive the stock long term. You're going to want to keep a very close eye on those USD growth metrics in Q2. Thank you so much for joining me for this explainer. Keep analyzing the data, and I'll see you in the next briefing.